Right, we can get going. Olga, thank you very much for that lovely music. Welcome back to All for Boutiques on Wednesdays. I know it's cold today, but not long from now, I'm sure we will experience some hot summer days again, wishing for winter. You know how it goes. As seasons change, so does market cycles. The only difference is that seasonal changes are more predictable, is it not? We've experienced some horrible events the past 2 weeks, and it does raise a lot of questions on SA property that's already under a lot of pressure. The waves of COVID globally further continues to impact on behavior of people, which will probably have a longer lasting effect on property around the globe. And it does raise a lot of questions on how we look at property in our client portfolios going forward. With us today is two of the top property managers, Mike Flax, Director at Visio Fund Managers, and Gareth Elston, Chief Investment Officer at Reitway Global, speaking to local and global property. Just a reminder to our audience, since we have two presenters today, the session will run a little bit longer. So the presenters will continue till roughly about 9:10. And I am going to make 10 minutes provision for questions. I'm sure there's going to be a lot of questions on property. Like I said, a lot of things has changed. So we should finish up around about 9:20. So just bear with us. But like I said, I'm sure there's going to be a very interesting session. Mike and Gareth, good morning. Thank you so much for joining us. It's always great to have you with us, and your time is always very greatly appreciated. So thank you for that. Mike, you up first, and Gareth will follow directly after you. We'll hold off with questions until both presentations are done, and then we'll see what comes in the chat room. To the audience again, just a reminder, more than welcome to post questions in the chat room. We'll take them or cover as many of them as we can. Mike, thank you very much. I just want to see quickly. You should be able to share your presentation now, Mike.
Sure. Thank you, and good morning to you all from freezing Cape Town. And thanks very much for that warm welcome, Eugene. Great to be here again, and great to be sharing the platform with Gareth. I'll get my presentation up quickly.
Okay.
Okay.
Yeah, it's coming through now. I can see it. Full presentation, Mike. Absolutely perfect. Thanks, Mike.
Yeah, so while Gareth is going to be covering international REIT issues, I'm going to be looking at the impact of this catastrophic unrest on local REITs. And also, if time permits, we'll discuss prospects for SA office property. It would probably be remiss of me to not take this opportunity in a few moments just to crow about my fund's performance. We've been running our Visio Property Fund now for a full year. So we now have a one-year track record that we're very proud of. So for all of those of you who wanted to wait to see how we perform, here it is, our first year, 26.7% return against our composite benchmark of 16.1%. So we produced an alpha of just over 10%. Just a reminder of what kind of mandate we run. We unconstrained, and we can invest in property companies anywhere in the world, wherever we think we have the best ideas. And that's exactly what we do. We follow our best instincts, and it's kind of worked for us so far. Just to have a look at our exposure around the world, we are pretty well spread around. We do have some South African exposure as well. Seeing we hear, and we do get to hear of some of the best ideas from time to time. Sectorially, we're in the traditional property types, largest exposure to retail property, and that's mainly because that's where the value gaps were over the last year. They've really started to come back quite nicely, the retail stocks. We've also got substantial exposure to the burgeoning logistics space. And as all of you know, as e-commerce continues to grow in just about every single country, so does the demand, and so does rentals for modern warehouses grow. So we'll probably keep on adding to this kind of exposure. Onto the impact of the civil unrest on REITs. So pictures like this have left us, all of us, I'm sure, in shock and in deep despair about our country. And while I'm sure many of you are probably questioning your own future here, I need to ask the question as to how this will impact on the value of South African REITs. Just what I'll cover is what is the damage, how much damage, which REITs are really very exposed. Sasria, will they be able to cover the costs? What about going forward in the future and insurance costs? How about brand South Africa, brand KZN, and could possibly the Western Cape benefit? This schematic is quite interesting. It was drawn up by SAPOA. They try to quantify the damage, but it's still early days, and I think pretty much understated so far. As you can see, over 200 shopping centers have been damaged badly to various extents, some burnt down, some just 50% damaged. 170 warehouses and liquor distributors have been destroyed in most cases, looted and destroyed. Stock issues, it was estimated at 1.5 billion in Durban, but I don't believe that. I think there are warehouses that were holding 500 to 1 billion rands worth of stock, just individual warehouses. So I think this number is probably closer to 10 billion rand in stock losses. 1,400 ATMs, imagine that, were blown up or stolen, damaged. That's quite a number. The scale of the damage is really quite huge. Estimated 20 billion on KZN GDP. I think the damages in KZN could well be over 30 billion. And the estimate on our national GDP, over 50 billion. And then the stores have started reporting as to what has been impacted and damaged. At the point of this slide, Pick n Pay and Shoprite hadn't reported yet, but there's probably another 1,000 stores that you can add to this schematic. So it's huge. It's huge, and it's going to have an impact on. Really a big impact. So looking at damage to REITs, and this is also outdated because I did get a schematic yesterday, but too late to add to this, from Adrian Jardine, who runs South Alpha, and he's updated a lot of these numbers. For instance, Growthpoint reported that close to 3% of their portfolio has been, the South African portfolio has been pretty much damaged, all of it in KZN. So the numbers are big. The two biggest exposures probably to retail companies, Vukile and Resilient. The numbers, in fact, are updated. Vukile, probably over 13% of their portfolio has been damaged. Resilient, over 10%. So there's been a fair amount of impact, and a number of other REITs as well have reported. Arrowhead, Fairvest, I think Dipula, you name them. There are very few without some kind of exposure to KZN. How have share prices reacted? And in fact, have they reacted enough so far? Just look at Vukile and Resilient. Vukile, off their pre-unrest level, has fallen about 11%, and Resilient down just about 8% off their pre-level. So the question is this enough adjustment? Can we quantify what the damage is and how it's going to affect the income statements? Just looking at what the giants have done, Redefine and Growthpoint, in fact, have even reacted even more. Even though we know Redefine and Growthpoint have probably only had damage to about 3% of their portfolio. But I suppose they are bellwethers for the economy, and they've taken hits around that 13% level. Yeah, not pretty at all. So the big question is, I suppose, can Sasria honor these claims of, I reckon, in the property industry, up to 35 billion rand? What we know about Sasria so far is that they've got less than a net 7 billion rand available on its balance sheet in investments. It's a net of liabilities. We also know that back in the early 2000s, 50 billion rand was transferred from Sasria's reserves to the government's fiscus. Why? Because the feeling was then we were in a post-democratic South Africa and we weren't likely to see unrest. Kind of how wrong were they? How good is Sasria at covering claims? Well, we know that they still owe Richards Bay Minerals over 300 million for looting that happened in 2017. So possibly not that great. There's no real history of having to pay out big numbers in an unrest situation. The maximum we know that they can pay out to any single claimant is 1.5 billion. That's the maximum if you've got 3 lots of cover. So any of these funds, Bukili, Resilient, would be capped out at 1.5 billion. That's if SASRI even have the capital to make those kind of payments. We do know that SASRI reinsure, so they do have abilities to increase their essentially their cover beyond their own capital. About 20% of the premiums, in fact, are spent on reinsuring with a number of the large reinsurers. They haven't told us who they are or what that cover is, but we know that it's probably with the big guys like Zurich, Swiss, Alliance Re. So it could come down to some of these reinsurers and the reinsurance policies as to whether South Africa and South African fiscus suffers a major rupture or not. And what about SASRI afterwards? You know, what happens? Can they recapitalize? Who's going to cover the REITs going forward for these kind of things? And we know that banks won't lend you money unless you've got right insurance. So what are the banks going to do with the kind of debt that they've lent into the industry? So the question is, will SASRI still be around once the dust is settled and all the claims have been settled? If they do, will there be any capital left? Will government have funds to recapitalize SASRI? Or alternatively, is there other insurance cover available for rights? I know that Growthpoint have some policies through Lloyd's of London. Not sure of the full extent of it, but this is extremely expensive. So we know that at best, premiums for South African REITs are going to go through the roof. And that's going to affect distributions. That's going to affect net operating income and distributions. We think you could see a doubling of insurance premiums. Currently probably running at an average of 1.5% of turnover at the moment. Insurance premiums could go to about 3% of turnover. It could impact on your distributions by about 2%. That's just the one cost of insurance, assuming you can get it. So this is very concerning. What happens with SASRI? Can they cover things? And what happens in the future? And then, of course, Brand South Africa. You know, major impact. I don't know what's going to happen, but I mean, these are some quotes from the Fin24. Rights puts Brand SA at risk, create death knell as international tourists plan for their peak season. Tourism is probably destroyed for this coming season, because I think individuals will just have one look at the news and will plan for their December, January holiday somewhere else. So that's going to affect your hotel funds. Again, I mean, they've been so badly hammered, and your hotel funds are really going to be on their knees again. Hospitality Fund, SOGO, plus all the other hotel funds. Mpume Langa from the Durban Chamber wrote that companies in the Durban area are talking disinvestment already from KZN and South Africa. And they're trying to convince him otherwise. We saw reports yesterday in the press about Toyota considering their future, the biggest employer in KZN are considering. I think the smaller companies that can possibly get up and reestablish themselves somewhere else could well disappear. And then, of course, even if you have a shopping center that's been destroyed, and even if you do eventually get your insurance money back, your line shops, your mom and pops will probably disappear. They're not going to be able to stay alive until SASRI pay them out. So the shopping center funds are going to have massive vacancies, massive voids in their shopping centers. Obviously, the nationals will be able to withstand this. They've got the balance sheets to withstand this and rebuild over time. But we don't think the REITs are going to be able to, even in a best case scenario where Sergio Pout, they're going to be losing business rentals during the period, and they're going to be losing tenants. And that's unfortunate situation. It's going to impact on any real estate in KZN, especially those that have been damaged, and it's got the knock-on effect on brand South Africa. So some huge issues, and I suppose there may be some beneficiaries from this. You know, there is talk about some kind of semigration to the Cape, and I suppose the semigration will bring some of the smaller operators who can just get up and go. So there may be some benefits to the office vacancies in the Western Cape, and there's already talk out that there are a number of leasing requirements from some KZN distributors who are now looking to set up warehousing in the Cape. It just can't be supplied right now, from what I understand, but there's a number of leasing inquiries in the Western Cape. And I suppose your Western Cape centric REITs will benefit from this. The only one that's pure Western Cape is Spear REIT, but there are a few other REITs that do have some largest exposure to the Western Cape. So all in all, not a good thing for South African REITs, this violence. To quantify exactly what it's going to do over the long term, we're not sure, but as we've seen, share prices down about 10% as a result. Is it enough? Maybe it is. Time will tell. We've obviously really had a fair amount of run up this year in share prices. So I think a lot of the growth and a lot of the gains from this year probably will be pared back over the year, and we may end the year reasonably flat in terms of total returns. See, I've still got a couple of minutes to discuss SA office prospects, and the question is, I suppose, are they worsening? And the big issue is work from home. I mean, it's on every single corporate's lips. Every executive is pronouncing on it, and it's pretty much a win-win for the executives who can talk quite aggressively on the fact that they're going to be going with a hybrid model, and it's great because they're appeasing the employees, reassuring and comforting for the employees, knowing that maybe, you know, you can work at home a couple of days a week. It's great for their shareholders because shareholders know they'll be cutting back on space and then overheads. And then I suppose it also helps these corporates to make big pronouncements and work from home when it comes to lease negotiations, because it really puts landlords on the back foot. So it's pretty much a win-win for any corporate executive to talk about work from home. What will its impact really be? It's no doubt there will be a negative impact on office demand. There are a couple of bearish issues. We're already seeing large-scale subleasing taking place. Big law firms, big accounting firms putting sublet space back on the market. We call it grey space. It doesn't often appear in the official vacancy numbers, but it's there. And the problem is that your tenants who've got, let's say, 2 or 3 years left on a lease and want to get rid of 50% of their space aren't interested in protecting the rental market. They'll just cut to nothing and obviously undercut the entire market, which brings down rentals. We're already seeing a very almost non-existent development pre-leasing happening. And then, of course, our GDP in this country is anemic, and the riots will probably cut another % off our forward GDP numbers for the next year. And this is what takes up new space. What could be, what are the bullish issues that could impact on space requirements? Well, we're seeing that the requirement for social distancing, which means more space per employee. So your densities are probably now set to decrease. And then I'll just show you a slide just now on occupancy costs, showing that really office occupancy costs as a percentage of payroll are quite low relative to, let's say, retail. What's happened to vacancy rates globally, you can see them all ticking up. This is the US, ticked up to about 18% already. South Africa, I don't have the number in here, but it's also probably very similar to the US. But there's been a tick up all around the world in vacancy rates. And this was starting to happen even before the pandemic. but is obviously being exacerbated. So I think vacancy rates are probably rising on average 5% in most markets, let's say additional 20% vacancy as a result. This was what was happening over the last, say, 50 years. There was a decrease in the amount of space per user, but obviously with the advent of COVID and social distancing, we're going to see this tick up. So this is obviously the bull case for more space, but it's just really going to temper and add a little bit of, it's going to reduce the vacancy slightly. So this is going to probably tick up, and you're probably going to see space requirements going up. Just quickly looking at what space requirements have done around the world. And you can see in Toronto, average space per employee up at 15 square meters now. And this is going to rise. So unfortunately, I don't have the numbers for SA here. And then you can just see what's interesting is what office rental costs as a percentage of payroll, about 12% versus retail, where rentals are probably about half payroll. So it's actually not hugely material, your office rentals for most companies, but I suppose a saving is a saving. And if a corporate can make that saving and at the same time offer flexible working to employees, they're going to take that gap. So just to summarize, I see my time is out. Sublets, the grey space, putting massive downward pressure on rentals in SA. I think corporates will on average give up about 20% of their space when their leases expire. There is, which I didn't talk about on the bull side, but there is conversions happening. We're seeing offices being converted to residential in many cases. And possibly over time, those that can be converted will be converted to resi, and that does take some of this huge vacancy out of the market. But the remaining vacancy, I think, is going to take at least 5 years to absorb, assuming reasonable growth rates in the SA economy. So on rentals, and especially those REITs with the exposure to office, which is most of the non-specialized REITs, there's probably going to be zero nominal rental growth for the next few years, which means a decrease in net income from offices. Because one thing that's not happening is that op costs aren't coming down. Municipalities are demanding their rates, and they're pushing up rates at an increase above inflation. We're going to see more demand on security going forward after these events. And of course, the insurance costs, which isn't immaterial, assuming you can find it. Assuming companies are going to be able to find insurance, it's going to knock 2% off their bottom line, just the increase. And then the environmental demands. Even in these tough times, tenants are demanding green buildings, and that costs money. Landlords have to modernize and spend money on capex. So I don't think the next 5 years are very rosy for the office market. We've certainly taken a view that we will lighten our office load where we can, but often very difficult because most REITs have office exposure. That's me. Thank you very much for your time. I'm going to pass on to Gareth.
Mike, thank you very much for that. I feel a bit like Kevin McCullers from Home Alone. It's like, so you had a tough job. There's a couple of questions that came in the chat room, but we'll take it after Gareth. Gareth, you should be able to share now. Yes, I can see your presentation, and you can go straight ahead. Gareth, thank you very much. Hi, Gareth.
Excellent. Yeah, there we go.
Yeah, got you. Perfect. Thank you.
Perfect. Thanks everyone for joining this morning. Let's get straight into it. Yeah, so just my team, myself, very ably assisted by Martin and Marius. It's definitely been a year and a half of interesting developments within the market, but the team is holding up well. Performance is good, and I think we are all doing as well as can be expected. Our product, just to remind everyone, is that we have 3 domiciles that we are available in, including Australia, Malta, and South Africa. Our funds feed into Malta, so just to remember that all the funds replicate a master portfolio across all of them, except for the enhanced and the hedge funds as well. So we've had a very good year and a half, very strong performance with our funds in South Africa and in Australia, all 5-star funds, and we're very proud of that and working hard to keep that going. Our exposure globally, the bulk of our exposure, unsurprisingly, is to the US at the moment. The US, as most of you all know, is the largest REIT market globally and just the property market globally, also opening up the fastest, returning to economic normality the fastest too, which is why we've upped our exposure there over the past few months. Then good exposure to Europe and the UK, cut our exposure quite a bit towards the east, especially to China as well as Hong Kong, and also Australia as well, which proved to be a little bit prescient just as they started to get hit with new COVID cases as well. So that was a relief. Started to slightly look at Japan again, but we wouldn't just, Japan always has issues with growth. So we've had some nice bounces and recoveries there on the trade as things return to normal there as well. But we watch the East with wary eyes at times. Our exposure at the moment is primarily towards, on an overweight basis, is on the residential side, as well as the specialized sectors, which are data centers and cell phone towers. You'll see that we've now started to have a little bit more retail than we would have had last year, but being very specific and picky as to where we're going in with retail at the moment. I'll discuss it in a little bit more depth later on, but still thinking that parts of retail are definitely getting frothy, while other parts still do offer value. But we certainly think there are parts that are turning into value traps as the year moves forward. We've also have a bit of exposure to the triple net gaming sector, which a lot of you might not know, which these are the companies that own the facilities that the casinos, convention centers, etc., run primarily in markets like Las Vegas. So we've started to go into that. And then also small exposure to timber. As you know, it's one of the asset classes that we've played in throughout the year. It's been very volatile this year. If you've ever looked at the lumber futures market, it has been a little bit crazy as well. And then our small overweights to the industrial side, industrial logistics, still remains a fabulously performing sector over the past 3+ years, and we still remain very, very bullish on it. Our performance, was very happy with our performance since the fund's inception. We are about to go into 10 years track record next year. We are still the #1 fund across 3, 5, all the way through to 9 years. This year we're lagging a little bit, and that's primarily, I think, just because of us not buying into certain parts of especially the retail rally that we saw happening in Q1 of this year. We do think that it's overdone. We would rather stick to what we believe in and our overweights, and to not just basically follow the herd for the sake of it. It has served us well over the years, and we continue to believe that we'll start to see our overweights and sector overweights start to perform a lot better as the year moves forward. Early on into this the second half of the year, we are starting to see that, so quite happy with that. But we remain very happy with our performance, and we believe our investors are happy too. Looking at a 3-year basis as well, we are very pleased with our outperformance of both the index and our peer group, and continue to work on delivering that. Looking at the period of COVID, which we really take from the start of last year when the news started to come out of China up until now, there have been very definite phases within the whole global pandemic as things have played out. So really, at the start of last year, very strong run-ups in global listed property, at times actually making no real sense considering the underlying market conditions. A lot of calm, a lot of run up, and then we had the COVID crash coming in March. We managed to avoid the bulk of that, which was very pleasing. We had the Fed riding to the rescue, and then moving on from April last year up until we had the vaccine bounce that came in November. A lot of uncertainty within the market, a lot of just no direction, uncertainty. But then with the vaccine bounce, we saw that really driving a lot of positivity on a very rapid basis, probably a little overdone at times as well. The vast bulk of this year thus far, we've seen the opening rotation, which drove very strongly, especially on parts of retail and even parts of office, actually, for a little bit of Q1. And that then starting to peter out towards the end of February. where we've started to see what we view as potentially the return to normality. It still is probably a little too soon actually to tell, and looking at the way things are at the moment, it probably is a little too soon to tell. We are certainly not out of the woods with this yet. But if you have a look at our performance during the period of COVID versus the benchmark from the start of last year to the end of last month, is, we have still managed to generate close to almost 20% alpha versus the benchmark, which we are very happy with. Looking at the performance of sectors, it's been the first year thus far to date that we've actually seen regional malls coming to the top of the table. Typically, they've been lagging for over 10 years. Obviously, at the end of last year, they were the worst performing sector. So a lot of that really is, I think, people buying into the belief that they were oversold and it was time to come back. We think that was part of that with some parts of the malls, but definitely not all of them. And we do think that things are getting a little bit frothy. When you're looking at large malls trading at premium to NAV, that does start to concern us, considering all the issues that the malls will actually have to face going forward. Looking at the performance, what we do is we track all the sectors throughout every month, every day. This is just going back to the start of the COVID period and looking how the various, just taking 5 selected sectors here of retail, industrial, specialized, office and residential, how these have performed since the start of COVID. Obviously, extremely strong performance coming from the data centers and towers at the start of the crisis, as we all switched to Zoom and are still stuck on Zoom. And then very strong performance, obviously, from industrial and logistics. And not just online shopping, a lot of movements of retailers to improved warehousing facilities. So about 30 to 35% of this industrial demand is driven by e-commerce. So still the bulk of it is actually outside of the e-commerce space, but it's really a very strong story. So you would have seen that data centers started to come off a little bit as the Fed came in, as we went into that valley of uncertainty, as I call it. And then this year, as we've started to come out of the reopening trade, and people have realized that they probably have oversold specialized, that we've had a strong bounce there. Looking at office and retail, the bulk of those holdings are still below pre-COVID levels, still taking a little bit of strain. There are some that have made back all the losses that they have, but still for several quite a way to go to. And this year, we just break it down to just have a look at how these sectors ended off last year. So you'll see specialized industrial warehousing ending off very strongly. You did have a very strong bounce as the vaccine news came out on the 9th of November for office and retail, but still just not enough. But looking at this year, is you have seen retail really ramping up very, very spectacularly as we came, going through the first bit of the year. We saw a bit of a sell-off coming through on the specialized sectors, which, as I mentioned, you started to see people realizing that, again, maybe that had been overdone. Office, really a tale of uncertainty, and I'll discuss that in a little bit more detail as well. But yeah, we're just not convinced that this retail really actually has the legs that people might be thinking it has. The plus is that we have started to see transaction volumes picking up a little bit. We starting to see, within between January and May, a little bit better than last year, but still, we have to go back all the way to 2014, 2015 to see numbers that low. Projections looking at a level of about $446 billion. Whether this is going to happen, we're just not sure. But again, very low. You have to go back quite a few years to get back to where those levels were. But the plus is that the cap rates have come down and are still holding relatively stably where they were last year. So it's going to be interesting to see how the rest of this year pans out on that. The sectors that are seeing the most volumes, not really surprisingly, within, especially in North America, Australia, apartments and housing have had very strong years, very strong demand, very strong price appreciation within it. Also, obviously, on the industrial side too, office coming off, retail being flat and low still, and your CBD office also quite low. Lodging picking up a little bit as well. They were really hammered last year, but they are starting to normalize a bit too. So what we do as well is we do these dashboards looking at each of the sectors. We do these for all the sectors. I'm not going to go through every sector. As you guys might know, I've mentioned we have about 25 sectors and subsectors that we look at. So I'm not going to go through 25 and subject you to it. But you'll get the presentation. You can have a look at this. So these we look at how the sectors are performing, how they are in the indices, what the occupancy levels are on a weighted average basis across the universe that we look at, what the growth is looking like, the yields, what we're seeing the premium to NAV at. Looking at retail, we're still pretty negative on it. As I mentioned, what concerns us is, especially on a weighted basis, is seeing premiums to NAV we just don't think are sustainable. Retail, even large malls in first world markets, they have a lot of COVID issues still to deal with going forward. They have a lot of the COVID issues from last year still to absorb and move on from. You still have very large REITs like Reitway, for example, that have suspended their distributions. We're not sure when those are going to be coming up. So they're not out the woods yet. If we were to choose a sector within retail, we would favor strip centers within the US. Industrial, we are still very positive on all of these aspects globally, especially. We still believe it has legs and a long way to go. Our favored exposure there would be to the pan-European market within the logistics and warehousing side. Residential, again, another market that we are very, very positive on, very strong demand, very good numbers coming through. We do think that probably most analysts are getting the demand numbers and the cash flow numbers wrong as to what we would be expecting, but we're moving into earnings season now, so we'll soon see whether our hypothesis on this has been right. The sector there that we like the most are single family rentals, which are houses for rent in the US. They've had a fabulous year, and we continue to see them as doing very well on that. The same with the specialized sector, data centers and towers. We have been very positive on this for many years. We still see it continuing to grow and drive, not just as people continue to work from home and to use Zoom, but again, the continued data demands from entertainment, from telemetry systems and self-driving cars. We're just, again, not seeing this as drying up anytime soon. Office today is the sector where there really is the most noise and uncertainty. A little bit, as Mike mentioned, part of it is used by tenants to beat up landlords. With the uncertainty, you have a power dynamic shifting from the landlords to tenants, but demand is not really where it is. There's still a lot of supply as well coming online within the developed world as well. How much of this can be absorbed and the effect that that's going to have as well on rentals is definitely going to be a factor coming through. If we have to choose a sector here, and one which we're actually quite happy to choose and have liked being in for the past 3 years, is the life science sector, biotech. They've obviously benefited greatly from biotech trends over the past few years, and the massive amount of work that's gone into obviously the COVID fighting. Having a look at US rental growth and vacancy rates, as you see now, we start to have a continued uptick in vacancy rates and a slowdown in rental growth. This is really not where you want to be in terms of office. Europe is the same. Europe, though, has some niche markets that we are actually seeing some growth in, certain parts of London and a few parts of Germany as well, where we're seeing this too. But in general, the numbers are again not positive on that. What we also do is we look at alternative data to see what's really happening with the noise around. Are people moving back to the office? Is there a change in what's happening? And this is from a company called Apptopia, and this is just looking at an index of WeWork downloads versus Zoom downloads. So WeWork typically is if you're using their flexible offices, as you would be using and accessing it via the app to book your space. Zoom, the usage obviously of the system that we're on at the moment, and how this has changed. What we've started to see is an uptick in WeWork usage, starting to see a bit of a downtick in Zoom. This is for the UK, just to mention. But if you look at it in terms of the longer timeline and not just from the start of this year, you'll see there's still quite a long way to move. So it seems to be trending a little bit positively in the UK. Having a look at another can be quite a strange index, which is called the Pret index. For those of you who've traveled around, especially the UK and the US, will know Pret a Manger is a sandwich shop. So what this does is it looks at the online shopping trends and where they're seeing their demand versus where they were pre-COVID in various markets that they're in. So they provide this for London, Hong Kong, Paris, New York, break it down also for different parts of London, the Midtown as well as downtown New York City. You can see Hong Kong is the one getting closest to pre-pandemic levels, but when you're looking at London and New York, those levels are still pretty down, trending slightly up, but nothing yet that really just shows that we're through with this. The same things we're seeing with transport data for New York as well as London. New York is still 54% below pre-pandemic levels in terms of ridership. UK a little bit better in London, but still 45% below pre-pandemic, which is really not helpful. And another one of the tools that we get is the Back to Work barometer from Castle Systems, who provide access control for offices and facilities in the US. You'll see again also that looking back to pre-pandemic levels, the vast bulk of the US is really below where they were. The main upticks really coming through in Sunbelt areas, the southern parts of the US, but it's still, while it's looking a little bit more positive, it's still pretty negative. So just to end and sum up, we still think that this year is going to be volatile. There's still a lot of change and challenge coming through. Vaccines are definitely changing the narrative within how things have been developing, but rates are slowing down in parts of the first world. Parts of the developing world, as we know, is still extremely slow. As Delta starts to move through and this vaccine hesitancy seems to be sticky in some of these areas, it will have a bigger impact. We saw that a little bit this week too. It's really not a crisis that's over yet. There's still quite a lot to happen. We are, though, not as worried about prolonged inflation as several other players might be, but we do keep a look on it. Again, to remember, is not all sectors will benefit from this. But we still remain the most positive on data centers and towers, logistics and warehousing, and then also on the residential side, primarily the single family rentals, as well as manufactured housing. And I think we're almost back on time. And thanks very much, and look forward to the questions.
Yeah, Gareth, absolutely well done. You're spot on with time. We've had a couple of questions that came into the chat room, and we'll try to deal with as most of them as we can. Gareth, while I've got you on the line, I know you guys don't do currency forecasting or anything like that, but just keep in mind when we do access your feeder fund, return spills out or spits out in ZAR. So from a SA investor perspective, we have to consider, what the impact of currency will be over the long time or over the long term. So there's a question in the chat room based on that, is exactly, what is your views on the ZAR going for, in the medium and long term? Can you see the ZAR softening further from current levels, or how do you see this play out?
I think the only thing that's certain about forecasting the ZAR is that the volatility is just going to be completely crazy, and trying to forecast it is, if I could get that right, I'd be speaking to you for a sat phone from my yacht in the Caribbean at the moment. So our view, typically how we like to phrase it, is we aim for currency diversification, which allows investors to hedge their exposure to a range of global currencies. When looking at the ZAR, our view is that over the medium to long term is the ZAR will always lose parts of its value, but it's really an investment that you need to make over the long term. It's not big with the foreign exposure. You can't just try and time in and jump out. The rand can move very strongly in both directions, and trying to time it is just it's a fool's errand at times. So you need to, I think, invest in property for the medium to long term, and as an investor in global property with that diversification of the base currencies, is you typically will be well served and well hedged versus just having South African exposure.
I couldn't agree with you more. And I mean, global property is very diverse, or far more diverse than the SA sector. And Mike, that actually brings me to the next question. I'm trying to find some points of sunshine or sunlight here. You know, we know that it's a rich space. You know, the sectors are very limited. So my question is, you know, given all the information you gave us now, it's still unfolding. We're not 100% sure where this is going to end up. But, you know, it looks like there's no place to hide. How do you, or can you reposition your fund to extent where you can dodge some of these bullets? And in the same breath, you know, in the same question, how peer group cognate or benchmark cognate are you? Can you move a lot away from that to try and find some opportunities, and where are those opportunities?
Yeah, I mean, with our fund, we're fairly flexible. If we want to sell out of South African REITs, we can do that, you know. Obviously, they've adjusted downwards in the main over the last week or so, and we're cognizant of that. So, you know, there may still be reason to hold on and hope they recover a little bit, because possibly the damage has been done. But no, we're totally flexible. We don't try and hug any kind of index. We are, you know, if we were index huggers to a large, and we would be more US centric, given that a large chunk of the global index is based on US REIT stocks. But no, so we look for opportunities wherever they may be. We don't look at specific index hugging at all.
Can you maybe give us one example of something that you are considering in position in your fund, given what we know at the moment?
Yeah, we just increased our exposure to Capital Land. It's a Singaporean fund manager, and it holds big stakes in a number of REITs across Asia. They are going through some corporate action and some unbundling, and we've spotted an opportunity for the sum of the parts to be worth a lot more than it's currently trading at. So we've increased our exposure through to Capital Land in Singapore. We already have a stake in their main retail and office fund called Capital Land Integrated Commercial and Retail Fund. So and we like, I mean, obviously we like the governance that Singapore offers in terms of the Asian space. Gareth alluded to the fact that it's been very difficult to invest in Asia, and especially Chinese property, because it's very opaque. But we're finding that with Singapore, some of the reporting is world standard, and that's where we are getting our Asian exposure.
Thanks, Mike. There's a question directed to Gareth, but Mike, I'm sure you can come in on this as well, because it's got to do with SA REITs. Please, could you give a view on the discount or number that the shares trade to the net asset value? Or in other words, you know, what is the danger that NAVs can being adjusted downwards even further, and like LTV coming under further pressure, and banks forcing REITs to raise capital at the bottom, you know? So what's the risk of NAVs just continuing to being re-rated downwards?
Yeah. Maybe I can try and answer, and Gareth can have a go. You know, SA REITs are still trading at fairly large discounts to NAVs, probably around 30% to their reported NAV, which means that the market doesn't really believe the valuations. I mean, that's really the bottom line. If the market believed the valuations, they would be trading at, you know, at very close to their NAV levels. However, I think the truth lies somewhere in between. So there is going to be ongoing downward revaluations, in my view, and probably we could see another 10% over the next year or so for most REITs. And those that have obviously been directly exposed to the unrest are going to see the largest kind of drops in valuations, because it's going to take a while for them to rebuild their portfolios, and they may well lose capital as a result of Sasria's non-delivery. Maybe Gareth can add to this. Yeah.
Yeah, look, I wouldn't disagree with that. I think the NAVs are probably a little bit higher than they really should be. And the problem also, you know, in South Africa is you have a small market. So once you've started to sell off to those who can buy the bits, you're selling off to who do you sell off to, especially as a large giant REIT like a Redefine or a Growth Point. There becomes a point where the market becomes a little opaque. The banks also, are pretty full with South African debt. So it's really a difficult situation for them. They've got to be pretty careful about what they can do. The valuers also are often caught between a rock and a hard place when it comes to the values that they want to put in and what the REITs want to see, what the banks want to see. But yeah, I think the market is bright enough to see that, and that's why you are seeing those discounts. But I wouldn't, as Mark said, I wouldn't think that anything is going down another 10 would be outside of the bounds of reality. I think we're going to start to see when the next set of results come out, a little bit clearer view of how things are, and then there, a couple of other issues again as well as we move forward with SA REITs around, again, my bugbear with companies that are not paying distributions, still trying to keep their REIT status, and these type of issues that are going to have to be dealt with as the year rolls forward and they move into, a potential thing of 2 years of not paying distributions and passing solvency and liquidity restrictions, which seems to still be being ignored by most analysts, and especially the JSE and parts of the REIT association too.
Thanks, Mike and Gareth. Gareth, you also spoke about residential property in your portfolio, big allocation to that. But Mike, more specifically, another question from the chat room: your medium-term prospects for residential property in SA?
Yeah, amazingly enough, I mean, volumes have been very high over the last year, mainly in the affordable level, market, under 5 million rand. I don't know if that's affordable to most, but certainly not in the luxury end. And there's been, reasonable, demand. But in quite a few of our markets, people invest in the buy-to-let, and often that's used for short-term letting, which is driven by tourism. And that's been hammered very, very hard. A lot of those units have been put back into the long-term leasing market, and the rentals have fallen substantially. So I think it's going to be tough. I think I think that's obviously the sentiment is poor right now, given the unrest we've had. I think everyone's going to be raising their requirement for return. So whereas in the past you may have wanted a 10% return from your SA property, you're now going to be looking for a 15% given the increased risk premiums in the short to medium term. So I'm not overly bullish, just given what we've experienced lately.
Thanks, Mike. Gareth, maybe just a question for you very quickly. You've showed some slides on storage as well, but it seems like your active positioning is neutral or flat. Just on storage, anything there that excites you or not?
Yeah, so we like storage a great deal. We are increasing our allocation to it at the moment, and it really is. It's one of the sectors that, for example, last year when we started to move to structure the portfolio to deal with the COVID world, is we put a bit more into storage, and the market really didn't react the way that we expected to, because storage, as you'll know, is a sector that does very well with disruption. And if there's anything we've had in the past year and a half, it's been disruption. So the market really has discounted storage to a great deal, but what started to happen coming through of Q1 this year is we're starting to see the very strong returns that we expected to see within the storage market. So the numbers are coming through a lot more positively, especially in the USA and the UK. They're doing very well, and we expect them to do very well. So if we look forward, we remain quite bullish on self-storage. It's a very responsive asset class. It's got short lease terms at times, which can be very good if we start to move into an inflationary environment. We like it globally, especially the US, Europe, even Australia will give you exposure to it. And locally, it's one of the few specific subsectors that you can really look at here as well. And storage is a very well managed company here as well.
Right, so. Gents, we're pretty much out of time. We've covered most of the questions. The questions that we didn't cover, we'll circulate back to you. You can add comments and we can get it back to the audience as well. We can see who it came from, so we'll do that. To our audience, thank you very much for your time this morning. Really appreciate it. Mike and Gareth, to both of you, thank you so much. This is clearly not the time just to buy the bigger market out there. You need active managers that are nimble enough to steer you through turmoil and troubled times. is to look at both of these funds, both the Reitway BCI Global Property Fund and the Visio BCI Property Fund are on most of the big lists or the big platforms. Just a quick reminder, next week, Wednesday, is not a morning session. That is our longest session, and because we are hosting International Fund Managers Blue Alpha Sands Capital Credo Wealth, it will be an afternoon session starting at 2 p.m. SA time. So just keep that in mind. You should have received the invites as well. And just a word of thanks again to the BCI team for arranging all these sessions. Really appreciate it. To our audience, thank you for your continued support. To our managers, Mike, Gareth, thank you so much for your time this morning. We really appreciate it, all the insights that you shared with us. If you need any more information, get hold of us or the BCI team, and we can get you in touch with either Mike or Gareth. Thank you so much, and we'll see you next week, Wednesday, the afternoon. Thanks, James.
Bye. Thank you. Bye.